Good morning. It's Monday, the 10th of February, and this is Govindraj Ethiraj, headquartered in broadcasting and streaming as always from Mumbai, India's financial capital, and welcome to another week. The top stories and themes. The stock markets are now wary of Trump announcements, unlike before. Will there be more interest rate cuts now? Gold is inching towards 90,000 rupees per 10 grams. Why are there long lines outside India's compressed natural gas or CNG pumps? And Europe stocks are suddenly looking hot.
This is the Core Report with Govindraj Ethiraj.
The markets are standing by. A 5-year wait for an interest rate cut which finally happened on Friday did not do much to cheer markets, which continued to slide away. The Reserve Bank of India had announced a 25 basis points repo rate cut from 6.5 to 6.25%. The central bank, however, left the policy stance unchanged. The Reserve Bank of India's Monetary Policy Committee also decided to maintain its neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. Now, on the stock markets, the Sensex swung sharply almost 900 points during the day on Friday before closing down 198 points at 77,860. Now, this was the third consecutive session the Sensex was down, though it was still positive for the week, ending about 354 points higher. The NSE Nifty 50 index was down about 43 points at 23,560. In the broader market, the mid-cap indices were up slightly, while the small-cap indices were slightly down. Foreign portfolio investors are still selling, by the way. Now, they've sold about $9.5 billion of Indian stocks in 2025. That's a month and 10 days of 2025. Now, Wall Street is wary of President Trump and his tariff moves, including the reciprocal tariffs, and stock prices were down on Friday on account of that. The Dow Jones fell about 444 points, or just under 1%, to close at 44,303 on Friday. The S&P was also down just under 1%. And the Nasdaq Composite was down more, about 1.4%. Now, Friday's losses left the major indices in the negative territory in that week, according to CNBC. Trump had said that he would announce next week, that's this week, reciprocal trade so that we are treated, that is, the United States is treated evenly with other countries. And he said this during a meeting with visiting Japanese Prime Minister Shigeru Ishiba. Amazon lost about 4% after its guidance disappointed investors. It called for a revenue growth of 5 to 9% in the first quarter, its weakest growth on record. Alphabet also continued to fall following somewhat disappointed results earlier in the week, according to CNBC. It's been a volatile week after all. Remember, this was the week where we saw the new tariffs on China, Canada, and Mexico. The Canada and Mexico tariffs were subsequently paused. Now, back to Indian markets, and this is interesting. There are still varying views on valuations. An unconfirmed report by a leading Wall Street brokerage says the Nifty's recent market correction is largely over, and it could resume its outperformance amongst emerging markets in 2025, assuming global conditions stay stable. Now, I'm saying unconfirmed because I have not been able to confirm, but it's quite likely that this is the real thing. Now, the firm expects India to be one of the best performing emerging markets, citing strong macroeconomic stability, forecasted earnings growth of 18 to 20% annually over the next 4 to 5 years, and robust domestic capital flows. It also says that the key catalysts include potential government reforms, fiscal policies, and a dovish central bank, that's the Reserve Bank of India. And it sees a roughly 20% upside in the BSE Sensex by 25. That's the end of this year, assuming once again stable growth, no US recession, and moderate oil prices. Now, all of this is broadly in sync with what a few others are saying, but if I get the exact details and the name, I will share that with you tomorrow. Now, on the other hand, here's the interesting thing. Well-known New York-based valuation guru and investor Aswath Damodharan, who I've interviewed in the past, wrote in his blog over the weekend that the most expensive market in the world is India. And no amount of hand-waving about the India story can justify paying 31 times earnings, 3 times revenue, and 20 times EBITDA in the aggregate for Indian companies. He also points out that the US and China fall into the expensive category, trading at much higher levels than the rest of the world on all 3 pricing metrics. Now, this observation was part of a research study he did on index performance across markets and put out over the weekend. By the way, India and China broadly returned just under 8% in 2024. So it was not a very good year for both these markets. And also, they performed very similarly. The United States was up 23%. And the best performing market was Argentina, which grew about 172%. But I guess it's unlikely we would, or any of us would, be investing there. Gold prices continue to rise. And meanwhile, gold prices continue to rise thanks to all this uncertainty that we've been talking about. On Friday, they rose for the sixth consecutive week thanks to rising trade tensions and general uncertainty, which is now creeping in and spreading. Spot gold gained slightly to about $2,861 per ounce on Friday. That's up more than 2% last week after hitting a record high of $2,886 earlier in the session, according to Reuters. The gold market also appears to have been buoyed by both continued growth in the People's Bank of China's gold holdings and a new Chinese program that allows insurance funds to invest in gold, an analyst told Reuters. Back in India, gold prices cooled off a little bit, but 24-karat gold is roughly around 86,670 or close to 87,000 rupees per gram, and 22-karat is about 79,460 for 10 grams once again. Now, while the prices are going a little up and down, it's obviously high, or rather it has appreciated substantially in the last year. Meanwhile, oil posted its third straight weekly decline on concerns that United States President Donald Trump's tariffs on China will hit demand, and that also outweighed America's first round of sanctions against Iran, according to Bloomberg. So Brent crude was quoting around $74.66 a barrel. That's under $75 a barrel over the weekend. Crude was down about 2% last week, following Trump's levies on imports from China and China's countermeasures, which were, of course, fairly limited or restricted. Refiners in China have apparently also slashed operating rates to lows last seen at the beginning of the pandemic. Will we see more cuts? India's central bank will be agile in responding to the liquidity needs of the banking system, the Reserve Bank of India's new governor, Sanjay Malhotra, told reporters on Saturday. He said that we will be very, very watchful, alert, and nimble and agile in whatever are the requirements of the banking system to provide liquidity, both transient overnight as well as more durable liquidity, he said. The term liquidity keeps coming up, or rather came up quite a few times, and more on that shortly. He also said that the Reserve Bank of India is not targeting any price band for the rupee and focusing more on curbing excess volatility, according to Reuters. So what can one take away from the first interest rate cut after 5 years to 6.25%, and what could be the impact and likely transmission? I spoke with Dr. K. Joseph Thomas, Head of Research for Emkay Wealth Management, and began by asking him how he was looking at the impact of this rate cut.
It's a good first step that the Reserve Bank of India has taken to address certain requirements of the economy. Because RBI Governor himself said that the inflation growth dynamics at this juncture has opened up a better space for Monetary Policy Committee to take rate decisions, which means that as far as growth is concerned, we have seen the growth slip to 5.4% in the last quarter, and it's likely to average out to around 6.4%. as forecast by RBI and some other agencies for the whole year. So rate of economic growth has come down quite substantially. Second thing is that when you go to inflation, as far as inflation is concerned, the problem was coming mainly from the food inflation. And in food inflation, it was the prices of fruits and onions and tomatoes, which had actually influenced the price level, and the food inflation, which was at around 10.87%, month before the last, has now come down to around 8.5%. And it is expected to be still lower, because for the current month and for the last month, it would be still lower because prices have actually come down. And it is expected to average out to around 4.20% for the next year. That's the view given by the RBI. So there is immense amount of comfort as far as inflation trajectory is concerned. And we do not expect any major impact of oil prices on inflationary expectations, because oil prices have stabilized in the range of around $75 to $80. That's the price of Brent, and we expect it to continue in that range most of the time. So there are concerns on growth. The concerns on account of inflation have moderated, and this has given RBI the space to cut the rates so that credit becomes cheaper and less expensive, especially for major sectors of the economy, including housing, giving housing loan at much cheaper rates, even corporate credit. So we need a cheaper credit to get over the current situation and then stimulate domestic demand, for which additionally the 1.1 lakh crores of tax concessions given to salaried persons is one of the things that go into supporting demand in the economy.
Do you see a time frame for this transmission?
Usually, transmission of rate cut happen over 3 to 6 months time period. And the medium of transmission, like when I'm speaking, the sound is transmitted through air or through electronic networks. Liquidity is the medium through which RBI policy transmits itself into the lower levels of the economy. So at this point of time, we see a deficit in the liquidity conditions, mainly on account of the RBI intervening in the currency markets and then taking away rupees on a regular basis to prevent a steep fall in the rupee against the dollar. So the medium of transmission, which is liquidity, is short at this point of time by approximately 50,000 crores of rupees, though it was as bad as deficit of 3 lakh crores few weeks back. It has come down now. That is after the CRR cut, which injected about 1.15 lakh crores, and then we had the open market operations also lined up. RBI's variable rate repos are on, the dollar rupees swap is there, and all these things have gone into reducing the liquidity deficit in the market to a significant extent. No such thing was announced in the monetary policy announcement because these liquidity related things are not required to be part of the core of the monetary policy. These can be taken and announced even outside of the monetary policy.
Yeah, but there was a sense of assurance of liquidity.
Absolutely. Even in the press conference subsequent to the monetary policy announcement, the governor assured the market that they will take care of the liquidity requirements and will be quite nimble about that. Earlier, many years back, RBI used to follow a monthly or a quarterly forecast of liquidity for the money markets. And currently, I think they do it even on a weekly basis and even on a daily basis. The money market conditions forecast is done at greater frequency. So which means that they are on the job and they have a more scientific analysis of things and they will respond to it as and when required.
What does this mean for how banks are going to perform, or how banks operations I mean financially, would be affected, I mean positively or otherwise?
Rate cuts are always, and also liquidity injection is always good for the market, for the banking system, because banks in the immediate banks will benefit from this, because the first thing that they would do is to bring down the deposit rates, and it is followed by a reduction in the lending rates. Lending rates come down slower and much later. The deposit rates come down much faster. Therefore, in the immediate, banks may gain on account of higher net interest margin. That's one of the benefits that would accrue to the banking system. With rate cuts and with better liquidity conditions in the interbank market, the bank treasury portfolios, which contain a lot of SLR securities and non-SLR, which have plenty of Government of India securities, they would gain in value with falling yields. Though today there was an uptick in the 10-year benchmark yields, we expect the overall market yields in the entire spectrum of maturities to gradually move down. And once these price gains on the portfolios, SLR, non-SLR, the banks would tend to book much higher treasury profits in the coming days.
Internationally, at least in the European Central Bank, UK Central Bank, and of course the Federal Reserve, we've seen a pattern of interest rate reductions. Now, this is India's first. Are you expecting or foreseeing something along those lines? I mean, a pattern of rate cuts?
Yes. We expect another 75 basis points to 100 basis points rate cut during the course of this calendar year. We have barely 1.5 months left for this financial year. And for the rest of the calendar year, that's from April to December, we expect a 75 basis points to 100 basis points further cut in the repo rate to come through, which would take us to around maybe 1.5% totally of rate cuts during the course of this year and towards the end of the next financial year. So this is just the beginning of the rate cut. Once RBI gets greater comfort as far as inflation is concerned, they will go in for further rate cuts. And this is the first rate cut after 5 years. And if you look at forecasts on the Fed rate cuts, last year, most of the year, people said that only in the second half of 2025, the Fed would go in for the first rate cut. But it happened much earlier than that. So we expect RBI to cut rates further and bring down the interest rates and also supply plenty of liquidity into the system, because there is a lot of comfort as far as inflation is concerned because it's moderating, and also greater comfort as far as greater need as far as the growth requirements are concerned. So the space is now open for the MPC to take those decisions. The final thing is that the monetary policy very well complements the fiscal policy and the fiscal measures announced in the budget. So both these two things working together should be good for growth and the stability for the economy.
Right, Joseph. Thank you so much for joining me.
Thanks, Govind. Thank you very much. Have a good weekend.
The rupee stabilizes. Elsewhere, for rupee watchers, last week was an easier one. Expectations that the Indian central bank will cut rates had also weighed on the rupee earlier in the week. On that day, the currency rose. That's the rupee rose slightly to end at about 87 rupees 42 paise after having declined nearly 1% on the week, its worst weekly performance since December 22, according to Reuters. Now, Asian currencies were mostly higher on Friday, and the Reserve Bank of India most probably did intervene to support the rupee ahead of the policy decision that came on Friday. The rate cut had a negligible impact on the rupee, with the dollar-rupee pair finding support from the governor's statement. The Reserve Bank of India forex intervention policy will continue to focus on smoothing excessive and disruptive volatility, according to a forex analyst who spoke to Reuters. The rupee had declined to its all-time low of 87 rupees 58 paise on Thursday, having now, of course, breached that 87 rupees mark following the announcement of US tariffs. Decoding compressed natural gas and the long lines for it. There is no doubt that compressed natural gas is a more economical option to petrol or diesel, and you can gauge that by the sales of cars that come pre-fitted with them, close to a dozen Maruti models, for example, apart from those who retrofit them. And it's quite likely that many of the ride-hailing cars that you usually get onto, or tourist cars as we call them, will most likely have a CNG gas cylinder at the back. Similarly, taxis too. Now, Bajaj Auto launched the first CNG two-wheeler, the Freedom 125, last year. So it's not just four-wheelers, but even two-wheelers. So, not surprisingly, there are long lines at CNG pumps, including in Mumbai, where I live. On the India Energy Week special series of interviews, I spoke to Kamal Kishore Chatiwal, chairman of the state-owned Indraprashta Gas Limited, which distributes CNG in Delhi and surrounding regions, as well as piped natural gas to homes in these regions. I asked him about why there were these unusually long lines, and then on to the fascinating mechanics of CNG distribution and how this fuel works.
Just to give you a brief, that CNG is another form of fuel, and unlike the liquid fuel, the density is very low here. So the filling time for the same amount of fill is slightly more. Say, for example, when you fill a petrol car, it takes say 1 minute or 2 minutes, depending on the condition of the fuel tank. If it is, say, you have to fill 10 liters, 20 liters, it may take 1 or 2 minutes. But if you have to fill a CNG, that will take 5 to 6 minutes. That is number one. Second is that in one fill, a car has, say, 40 liters of petrol. Whereas in one fill, the CNG vehicle has only 8 to 10 kgs. I mean, kg and liters, if you take equivalence, about 1.2 times liters or 1.23 times is the kg. So in one fill, you only get 8 kgs. So same car, if it is filled, you need to get it 5 times to get the equivalence, 4 to 5 times. So the number of trips to the fuel station, they also increase. Same number of vehicles, it gets 5 times. In a city, if there are 10 lakh vehicles, so for CNG, they become 50 lakh vehicles. Same distance, they will have to come to the station 4 to 5 times more. So that is the primary reason. And second is the filling time is slightly more, in the sense that 30 to 40% more than while filling the liquid, because the volumetric flow rate, and due to the safety concerns, safety reasons, that you need to maintain certain amount of flow rate and velocity of the fuel. And second is the number of trips the vehicle is making. These are the two reasons due to which you see. And to mitigate that, what the industry has to do is put up more stations. So that is what we are doing. And I'm very happy to share with you that in city of Delhi, you'll be pleased to know that there are more number of CNG stations than number of petrol and diesel stations. So we have around 400 petrol and diesel stations, whereas CNG stations are around 500. That is the way we are trying to mitigate. But still, I feel in a city like Delhi, which is growing very fast in terms of CNG vehicles, we need more infrastructure. This issue is very dear to us, that we need to mitigate this, and we need to create a situation where any CNG vehicle owner goes to a station and he finds it empty. One or two dispensers are empty. That is the kind of vision that we have for the city of Delhi and everywhere that we are operating.
What we spoke about is what's happening at the station. Now, take us backwards and tell us about the journey of either that cylinder of CNG and where it comes from, and what is the Indraprashta Gas Company all about?
See, the history of IGL, if I take you to the history of IGL, it goes back to late 1990s, when MGL was also formed around that time, 1996. So in the 90s, there was a situation in your cities where when they were running on diesel powered vehicles, as well as some thermal plants were also there. So while moving in the roads, you could see a lot of soot as well as a lot of particulate matter, SPM. So they were very, very high. Like, for example, I grew up in Delhi, and I can tell you that in the 90s, if you walk around without specs or without helmet or the open helmets, then you can clearly see that your eyes are red, as well as your clothes. If you wear white shirt, it may become slightly gray. Those kind of situation was there. So, and this became, I would say, a emergency kind of situation, especially in Delhi. So mandate came, or the stakeholders came together, and this was a new fuel that was already established in countries of Europe. So the technology was brought from there, and a pilot project was started by GAIL and BPCL in the 1996. And during that time, NGL was also formed, and a pilot project was started in Delhi. So this pilot project got converted into IGL. 23rd December 1998, IGL was formed. Subsequently, we set up infrastructure in Delhi. Immediately, people could feel that there was a difference in the air quality. In India, 50% of gas is domestically produced. Right now, say, if I talk about the total consumption of India, it's around 200 million standard cubic meters per day. Out of that, approximately 100 is domestically produced, and the other 100 is imported. And the import sources are US, Middle East, Russia, Australia, and other small countries. So those are the sources. And the major import points in India are Western Coast. We have the Dahej terminal, Hazira, Dahol, Kochi is also there. And on the eastern front, Dhamra is there, as well as Ennore. So these are the ports where the gas lands. Beauty of natural gas is that, unlike the liquid fuels, it is dependent on pipeline transport. So that makes it very, very safe, affordable, as well as from the environmental perspective, because when you are running a diesel vehicle carrying petrol or diesel or other fuels, so again, the emission from that vehicle is also there. So that gas comes to Delhi via pipeline. From there, we have the GAIL network. NCR region is serviced by GAIL. So from there, we get the gas through our city gate stations. And we have a network of 19 kg, which operates at 19 kg, the steel network. And subsequently, we have an MDP network, which operates at 4 kg. So the steel network caters to your CNG requirement, as well as it feeds to the MDP network. And the MDP network then goes to your PNG, which is industrial, commercial, as well as domestic connections. So that goes to, so it's a kind of a ring, you can say, where we have 4-5 inputs from various city gate stations. and then feeding to various NDP networks. So in a city like Delhi, we have around 25,000 kilometers of pipeline network, both MDP and as well as steel. So that is the kind of development that a typical CGD entity undertakes, that first you develop a steel network and then feed to the MDP network and then to your individual households.
The separation point, or rather, what is the separation point between compressed natural gas and piped natural gas? And what's the fundamental difference in the way either it's separated or it flows subsequently?
Basically, the molecule remains the same. Natural gas remains the same. Only the compressed natural gas, you have the pressure rating because it has to be filled in a cylinder. So we are operating at, say, 200 kg per centimeter square, or 200 bar, you can say. So that's the pressure in case of CNG. In case of piped natural gas, since households don't require too much pressure, but you need to transport the gas from one place to other. So a very small pressure of 4 kg is maintained in piped natural gas system. So that is the difference. And once it goes to the households, it is in millibar, less than 10 millibar.
Which I'm assuming is somewhat safer than classic cooking gas cylinder, which is at a much higher pressure.
The primary difference is that cooking gas is heavier than air. So the fundamental difference is natural gas is lighter than air because primarily it is methane, which has less molecular weight than air. And your cooking gas, the LPG, what you call in India, C3 and propane and butane, mixture of propane and butane, is heavier than air. So what happens in case of leakage? If it leaks, it remains on the surface. If it catches fire, if there's any spark, then there is a potential of major leak. But in case of natural gas, since it is lighter than air, it dissipates in the atmosphere. So that is a major plus, that the pressure, of course, in a cylinder, the pressure is also slightly higher and in a liquid form. So in case of any leakage, there is a potential that the gas will remain in that environment, and any spark, it can create a fire.
A logical layman question here. So obviously what is in the cooking gas cylinder or LPG, liquefied petroleum gas, comes from a refinery, whereas what you are distributing as natural gas comes naturally. It does not go through the refining process. Would that be correct?
More or less correct. Only difference is that the only refinement that it does is it is the residue after whatever fractions you have to extract from natural gas. Natural gas contains heavier fractions and the lighter fractions. So after extracting all the value-added fractions, you can say in carbon content-wise, C1 is methane and C2 is ethane, propane, butane. So you extract all those C2 plus components because they can be used for value-added products like petrochemicals and other chemicals, specialty chemicals and other chemicals. But C1, what is left, has a major role in fertilizer production and whatever is the residue of that. So you can say that the lighter fractions of natural gas, what is the residue after extracting all the C2 plus, is used in city gas station. City gas companies, they use this. Whereas the C3 and C4 are the fractions from refinery and they are mixed and then they are bottled. So all those effort is required. And you need to do it continuously. Like in gas, in PNG network, the advantage is you create an infrastructure one time and then the infrastructure can take care of for many years. Unlike the bottled gas, the infrastructure you have to create and a lot of logistics are required. First, you have to bring the raw material to that bottling plant, then it is bottled. Then again, you have to use some logistics to carry it to the retail stations. And then from there, the distribution to individual households. A lot of logistics are required, which is not required in case of pipe natural.
This segment was supported by the India Energy Week 2025, scheduled from February 11th to 14th in New Delhi, and you can register for the same using the link in the show notes. Guess which stocks are attracting attention? Well, some of the world's best performing large stocks this year are European banks like Societe Generale and Banco Santander and the luxury houses of Burberry and Richemont, a new report in the Wall Street Journal is saying, which is of course quite unexpected and out of the blue despite all these negatives, including a slowing Eurozone and the threat of Trumpian tariffs. One reason is deep sea. Investors had expected Trump's return to the White House would cement US stock outperformance, but that belief has been shaken after the rise of Chinese AI upstart DeepSeek and lackluster earnings from heavyweights like Alphabet, which owns Google, and Microsoft. Now, all of this has apparently pushed investors to reconsider unloved markets like those in Europe and Asia, according to Wall Street Journal. Meanwhile, the political, economic, and profit outlook for Europe is also improving, while hopes that Trump will negotiate a ceasefire between Ukraine and Russia, and that's also boosted stocks, particularly in Eastern Europe. But the larger point is that European indices look cheap. The S&P 500 trades at 22 times its projected earnings over the next 12 months, according to LSEG, compared with about 14 for the pan-continental stocks Europe 600 and 12 for UK stocks. On the other hand, profit growth is apparently picking up. Stocks Europe 600 companies per share earnings are expected to grow about 7.7 or just under 8% this year, according to FactSet, compared with just 2.6% in 2024. And of course, the dollar itself helps. The strength of the US economy and the dollar is good news for many large European companies, many of whom get more revenue from the United States than they get from their home market. This means that they are exposed to faster American growth, while a rising dollar makes those sales worth more when translated back into euros or pounds, says the Wall Street Journal. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.